The market in 2026 is setting up for big moves, but most investors will miss them. Not because there are no opportunities, but because they ignore the small names sitting under $5. Today, we'll walk through 4 cheap stocks that Wall Street analysts rate as buys, all trading under $5 a share. These are not lottery tickets. We'll look at what they do, why they might be undervalued, and what could move them higher. Stay with me to the end, because the last stock is both the riskiest and, in my view, the most explosive if things go right. If you're serious about building wealth, hit subscribe and tap like. We're building a community of investors who look past the noise. Let's get into the first stock. CURLF, ticker CURLF, trading around $2.35. On the surface, you might think Curaleaf is just another cannabis operator in a crowded space. But this is actually a multi-state operator with both US and international exposure, and it is building a full-stack branded consumer products business around cannabis. CURLF runs 2 main segments: domestic operations in the United States and international operations abroad. They grow, process, and sell cannabis products through both retail stores and wholesale channels. Think of their product lineup as a shelf in a dispensary: flower, pre-rolls, dry herb vapes, concentrates for dabbing, disposable pens, tinctures, capsules, edibles, balms, and lotions. On top of that, they also sell hemp-based products and cannabinoids like CBD and CBG, which can reach broader markets where THC remains restricted. As a business owner, that matters. Now, let's talk basic data. Curaleaf has a market cap around $1.5 billion. For a stock under $3, that tells you this is not a tiny microcap. It's a meaningful player in its industry. Volume averages over 800,000 shares a day, which means getting in and out is reasonable for most retail investors. Analysts as a group rate this stock a buy, which reflects expectations for growth as the cannabis market matures and more states move toward legalization or broader medical programs. We don't have all the detailed revenue and margin numbers here, but we can still think about valuation logic. Cannabis stocks have been beaten down for years due to regulatory risks, banking limits, and oversupply in some markets. That has pushed valuations well below what you see in more mature consumer sectors. In simple terms, price is what you pay, value is what you get. Curaleaf's share price reflects a lot of bad news that might already be baked in. If we see progress on US federal reform, rescheduling, or better access to banking, the valuation could re-rate fast. What are the key catalysts? First, any positive regulatory move in the US or Europe. Second, continued expansion of retail stores and wholesale relationships. Third, growth in non-THC cannabinoids and wellness products, which can move more freely across borders. The risk is clear. Cannabis remains a politically sensitive sector and capital costs are high. But for investors who can handle volatility, CURLF offers exposure to a long-term trend at a price per share that looks cheap compared to its market footprints. Stock number 2, Nano-X Imaging, ticker NNox, trades at about $2.70. At first glance, you might think this is just another small medtech company pitching a new device, but they are trying to reshape how X-ray and CT-like imaging is produced and delivered using a digital X-ray source and the cloud platform. The core idea is simple. Traditional imaging machines are big, expensive, and not easy to deploy in smaller hospitals or emerging markets. Nano-X is developing a commercial-grade tomographic imaging device with a digital micro-electromechanical systems cathode. In plain English, they're trying to build cheaper, more flexible imaging systems using semiconductor-like technology instead of old-school X-ray tubes. The business is not just the hardware. Their main solution is a multi-source system that links 2 pieces: NNox Dark, the imaging device, and NNox.CLUD, the back-end platform. NNox to CLUD is designed to store images, route them to radiologists, connect to AI tools for diagnostic help, handle billing, and manage reports. On top of that, there is NNox Marketplace, which connects imaging centers with radiologists, enabling remote reading of imaging data. They also sell teleradiology services and AI-based imaging software. Their AI tools aim to scan existing CT images to find underdiagnosed conditions like osteoporosis or cardiovascular issues. That can add value for hospitals, insurers, and pharma companies by squeezing more insight out of existing scans. From a business owner view, this is a platform play. Devices generate data. Data feeds the cloud. The cloud connects to radiologists and AI. That can create recurring service revenue, not just one-time equipment sales. On the numbers side, Nano-X has a market cap of about $169 million. The consensus Wall Street rating is buy, and the average price target sits around $7. That implies well over 100% upside from current levels if the analysts are right. Volume is healthy, trading roughly in line with its average daily volume, so liquidity is decent. The company is still early and likely not yet producing strong earnings per share. That means you are not buying a current cash machine. You are buying potential. The stock has already come down from the hype phase, which might create a disconnect between its long-term opportunity and the current market price. The big catalysts, regulatory clearances and commercial deployments of NNox.org, expanded deals for NNox.CLUD and teleradiology, and real-world proof that their AI tools can add value and win contracts. The risks are also high: delays in approvals, slower adoption by hospitals, and the usual competition from entrenched imaging giants. For risk-tolerant investors who believe in cheaper, cloud-based imaging, NNox at this price is a speculative growth bet with clear upside if execution improves. Next, we move into biotech. Stock number 3, Immunic, ticker IMUX, currently around $1.23 a share. You might think a tiny biotech like Immunic is just another science project burning cash. But this company is building a focused pipeline of oral immunology drugs targeting chronic inflammatory and autoimmune diseases. If even one of these hits, the upside from this market cap could be large. Immunic's lead program is IMU-838 in phase 3 trials for multiple sclerosis. That includes both relapsing and progressive forms. They are also testing it for moderate to severe ulcerative colitis. An oral selective immunology therapy that works across these areas would have significant commercial potential because MS and inflammatory bowel diseases are large, chronic markets where patients need long-term therapy. Their second program, IMU-856, is entering phase 2. This one aims to restore the intestinal barrier function in patients with celiac disease, inflammatory bowel disease, short bowel syndrome, IBS with diarrhea, and other gut barrier disorders. If successful, that could unlock a broad range of indications. A third program, IMU-381, is in preclinical development for gastrointestinal diseases. Preclinical means it is still being tested before human trials, so it's earlier and riskier. From a capital markets view, Immunic has a market cap of about $145 million. Volume is strong, with millions of shares trading daily, which indicates active interest and reasonable liquidity. Wall Street's consensus rating is buy, and the average price target sits around $6, implying a possible upside of several 100% if the trials go well. How do we think about valuation here? Price is what you pay, value is what you get. With early-stage biotech, current earnings do not tell the story. You look at the probability and size of future cash flows from successful drugs. A phase 3 MS asset alone, if it works and gets approved, can justify a much higher valuation than the current market cap. But there is serious binary risk. Trial failures, safety issues, or competition can crush the stock. The catalysts for Immunic are clear. Clinical trial readouts for IMU-838 and IMU-838 and IMU-856, partnership deals with larger pharma companies, and regulatory milestones. Each data release can move the stock sharply in either direction. This is not a stock for people who check prices every hour and panic. But if you understand drug development risk, IMUX under $2 offers leveraged exposure to a potentially valuable pipeline. Stock number 4, Adagene, ticker ADAG, trading around $2.84. Adagene is a clinical-stage biotech company focused on monoclonal antibody drugs for cancer. On the surface, you might say, there are many cancer antibody companies. Why this one? The answer lies in their platform approach and their focus on engineered antibodies they call power bodies and safe bodies. These are designed to improve targeting of tumors while reducing off-tumor toxicity. Their pipeline is broad for a company of this size. ADAG06 is a CD137 agonist antibody in phase 1b/2 trials for advanced solid tumors and non-Hodgkin's lymphoma. CD137 is an immune co-stimulatory target, Activating it can boost the body's immune response against cancer cells. ADG126 is a mass anti-CTLA4 antibody in phase 1 trials for advanced solid tumors. CTLA4 is a well-known checkpoint target, but standard CTLA4 drugs can cause heavy side effects. Adagene's mask design aims to activate more at the tumor site and less in healthy tissue. What does this mean in business terms? Adagene is not built around one single drug. They're building a modular platform to create and tune antibodies for different immune targets and tumor types. That gives them many shots on goal, and it also sets them up as a potential partner for big pharma firms looking to license innovative antibody formats. On the numbers side, Adagene has a market cap of about $142 million. Average daily volume is lower, under 100,000 shares, which means liquidity is thinner and the stock can move sharply on news. Analysts rate it a buy, with a consensus price target of about $7.67. That implies well over 100% upside if their programs move forward as hoped. Right now, the stock price reflects high risk, uncertainty, and the fact that they are still early. The catalysts are big clinical data readouts across several programs, partnership deals with large drug companies, and any sign that their masked and power body tech can deliver better safety or efficacy than standard antibodies. But make no mistake, this is high risk, high reward. Clinical setbacks, safety issues, or funding challenges can crush the equity. If you buy this, you must size your position small and be ready for volatility. This is not investing if you ignore the risks. It becomes pure speculation. To wrap this up, we looked at 4 sub-$5 stocks with buy ratings from Wall Street: Curaleaf in cannabis, Nano-X Imaging in medical imaging tech, Immunic in autoimmune and inflammatory disease, and Adagene in next-generation cancer antibodies. Each sits in a different sector, but the core idea is the same. You are not just buying a low share price. You are buying a business with specific assets, risks, and catalyst.bomb. Always do your own research. Position size based on your risk tolerance, and only risk money you can afford to lose, especially in volatile sectors like biotech and cannabis. If you found this breakdown helpful, hit subscribe, tap like, and share this with a friend who is hunting for ideas under $5. Invest wisely, stay focused on what matters, and I'll see you in the next one.